Steve, it seemed like the panic subsided for a bit yesterday, but today investors are back in fear mode. What do you make of what we've seen over the last 24 hours?
Hi. Yeah, well, we're back to the concept of return of capital outweighing return on capital. When you're in the situation where the assets that people deem the safest, or at least the ones they want to expose to the least amount of risk, being their deposits at banks, come into question, well, then everything sort of falls apart after that. People's attitude toward risk changed dramatically. That's why we saw markets start to fall last Thursday, continue Friday, continue Monday. Yesterday, I think I'm going to call a little bit, there's a bit of FOMO in there. There was just sort of people still don't want to miss the rally. They don't want to miss the bottom. So they jump back in and they sort of overdo it on the upside. And then, of course, this Credit Suisse news this morning was really, as Jared mentioned, an eye opener, despite the fact that we've been hearing bad news about Credit Suisse for months now, it seems. Banking crises don't go away quickly and easily, and they really affect people's psyche at the heart of their ability to take risk and process events.
Yeah, Steve, let's talk a little bit more about what we're seeing play out with Credit Suisse, because like you said, this bank has really been challenged here for several months. So compare Credit Suisse's situation to what we saw when it came to Silicon Valley Bank. How different are those two situations?
In many ways, Shauna, they're somewhat polar opposites. It's kind of weird. I mean, Silicon Valley Bank, they really got into trouble for being a plain vanilla bank. They had plenty of deposits. They got too many that they could deal with. So they then went out and bought what appeared to be safe assets, mostly government securities. The problem is they had what we call a duration mismatch. Your short-term deposits, which are liabilities to a bank, they can be called at any minute's notice. Your longer-term assets, which typically for a bank include things like company loans and mortgages and stuff like that, which they had too, those are not so easy to sell. And the problem is compounded when the yield curve inverts, because the money that you have to pay in interest on those short-term deposits starts to outpace the money that you're receiving on your longer-term assets. So when the banks when people started to want their money out of the bank, they then had to sell pretty much what they could, which was their treasury holdings. The problem is, because rates had gone up, those holdings had gone down in price. Eventually, at some point, they'll be worth par. But in a mark-to-market situation, all bets are off, and their ability to repay their depositors, fell short, because they just couldn't sell enough assets. Credit Suisse is fundamentally different. It's globally systemic. They've got, they're in more or less every capital markets business in most of your major economies all over the world. They're really systemically important to Switzerland. When you think about it, there's really two big banks. It's UBS and Credit Suisse, and the difference there is they've had their management instability. They got involved in the Archegos debacle when they've really stepped in it a number of times, and I think that's largely because of their difficulties in keeping a steady helm, and so it's very different. One is real vanilla, the other one is much further out there. But let me stress that even Credit Suisse isn't as stretched necessarily as some of the worst offenders that we saw in the global financial crisis.
Well, and to that point, I mean, what is the solution for Credit Suisse right now? How does the bleeding stop in the rest of the banking industry?
That is the trillion-dollar question, Ines. I think basically at some point, one of the reasons we got this little bit of a bounce here in the afternoon was there's talk that the Swiss authorities are actually going to do something or look into this. I don't know why. I don't know why it took them this long. It's not like this was a secret, but clearly they have to do something on their end, because it's really systemically important to the Swiss, but they can't do it on their own, because of Credit Suisse's role in so many other places. So, to the extent that they can organize something that staunches the bleeding, I don't think we're going to see the stock back anywhere near its level that it was at its heydays anytime soon. But at some point, it sounds like they're trying to come up with something to put a real, to actually do some surgery rather than put a Band-Aid on the patient.
Well, Steve, when you look at the bond market right now with yields plunging, it looks like the bond market at least is signaling the risk or really the scenario of a hard landing? Is that something that you see as more likely at this point?
Yes. I mean, I didn't actually see it as unlikely before, which I guess maybe is part of the answer to your question. But right now, the bonds are basically part of what I would call this get me out trade, this return of capital. Because you will get your money, you're going for no credit risk in treasuries. And by going for short-term treasuries rather than longer-term treasuries, you have less market exposure, less sensitivity to interest rates. The problem that we have here is if you can't price short-term risk-free assets, how do you expect to price risky assets like stocks? Basically every valuation model is centered around the idea of a risk-free rate of return. On top of it, if you're getting volatility in the stuff that's not supposed to be volatile, how you can't expect to not see volatility in other parts of your holdings or in the market. So that's a lot of what we're wrestling with the disjointed nature that we're seeing in short-term fixed income. It really puts us on tough sledding, and I don't see us being able to really calm down until or unless we see bond rates, come to some sort of equilibrium. 5 days of 20 plus basis point moves on a 2-year note is nuts by historical standards. I have no other word to put it.
It certainly is.
And until we
Yes, Steve, apologies for cutting you off there. It certainly is nuts. And then if we do get that hard landing scenario, which it sounds like you do believe is going to happen, how deep, though, is that recession going to be? Because I think that is what everyone is trying to figure out at this point.
I want to sort of separate it into two parts. I think financially, we're sort of seeing the process of the hard landing. Anything that revolved around liquidity, that rose on the way in has been suffering from the withdrawals on the way out. And withdrawals can be painful depending on, no matter what sort of situation you're talking about. Can we stay in good stead in terms of the broader economy? It's possible. And so I think we have to sort of separate the real world from the financial world to some extent, because we still see very strong JOLTS numbers, off their highs, but still there's many more available jobs than there are people to fill them, which means people have money to spend. It also, right now, they're not particularly confident about spending it. But I do think that, we could see a fairly hard landing financially, and clearly we've seen it in a couple of banks already, while not necessarily being quite so dramatic on the real economy side.
Lots of interesting stuff right there. Steve Sosnick, always great to have you. Thanks so much for joining us.